Hello and welcome to Fund to Money. Here we will be discussing the impact of capital gains tax on liquid funds and why this is important, because liquid funds are strongly recommended by people like us for emergencies or emergency funds. When you're building up emergency fund, we recommend that you buy liquid funds, and especially for income emergencies if you think you're going to lose a job, you're making a transition from one career to the other, you're about to set up a business, you've got irregular income, you want to take a year off for a course or something like that. For all of them, when you're actually making a provision, emergency provision to replace your income, that's when emergency funds are required, and we recommend for income emergencies you must have liquid funds. So that's why when you're wanting to build an emergency fund, liquid funds are required, and because you want to be using the liquid funds, you need to know the tax treatment so that you can smartly build. So there are other emergencies, which are medical emergencies, where there are other options that we recommend. Now, we have done this discussion about building emergency funds. The links are given in the description section. Here we'll be talking about the tax treatment and how it influences, or it should influence, how you should be planning for an emergency fund, how you should be building for an emergency fund so that you can use it in a tax efficient way. So that's what we're going to be discussing. We're going to be discussing the tax impact of capital gains tax impact on liquid funds, and we'll be coming up with the details in just a little while. Welcome back. Welcome to Fund to Money. We're discussing capital gains tax on liquid funds, and the reason why we are discussing it is because liquid funds are an important component of emergency funds. As we have mentioned in our discussion, whose links are given below, you need to have adequate insurance and a good emergency fund. You need to plan out according to your realities. That once you do that, that's when you should go for proper growth investments. Emergency fund, according to us, is the first investment, but it's defensive in nature. It's trying to protect you from all kinds of emergency, medical emergency and income emergency that we talked about in the introduction. So you can check out that discussion, but that's why in understanding capital gains tax treatment of liquid funds is important. So let's get started. Let's see how the impact happens. Now, liquid funds, as we know, are highly liquid. They're low risk because they invest in such investment options which are very low risk. They're very short tenured, so that it's easily accessible. So if it's obviously if you are investing in it, the important thing out there in terms of when it comes to emergency funds is that accessibility and low risk is more important rather than returns. But when you're actually investing for income emergency, the part where you're planning for an income emergency, there, because the amount is large, you cannot be just be content with any kind of return that comes in. For instance, if you're going to be putting the money in a bank savings account, currently you'll be getting somewhere in the vicinity, somewhere between 3.5% to 4% thereabouts, and that is way below the 10-year annual average inflation rate, which is in excess of 7%. So you need to keep a little bit of that in mind. However, as we said, the first important thing is not returns but accessibility. But here we're talking about the larger part, which is the income emergency. So let's get on to the tax treatment. So the first thing that you need to keep in mind is that if you end up using a liquid fund within 3 years of your investment, the units within 3 years of your investment, then they are treated as, and you make a capital gain, which you obviously will, because these are very low risk investments, then that will be taxed at your income tax rate or income tax slab, because it will be treated as short-term capital gains, and you pay short-term capital gains tax, and that of course short-term capital gains tax is your income tax rate. So till 3 years, this is you're basically what's happening is because somewhere between in the recent past, liquid funds have been returning in a 3-year period, I would say, between 5.5 to 5.8%, the good performing ones. So what's happening is you'll be doing a little better. If you look at the last 3 years, you'll be doing better than the savings bank account, but what's going to happen is you're going to be comparable to the FD rate, fixed deposit rate of this particular tenure. So it's pretty even Stevens till that point, but the moment it crosses 3 years, then the whole complexion changes. Why? Because then beyond 3 years, the gains are looked upon or they're termed as long-term capital gains. So there are two things that happen, as some of you would be knowing. Number one, you get inflation indexation benefits. So the cost of buying that unit gets enhanced by the proportion of increase in your inflation index. So if the inflation index has moved from 100 to 110 over the period past in the 3 years, so in the same proportion, the cost of your units would be enhanced. So the price at which you sell and the price at which you bought, now the new price, which is the enhanced price, the capital gains for tax purposes will be lesser, and on top of that you pay 20% long-term capital gains tax. So what is happening is, compare that with an FD of that similar tenure, which is a 3-year plus. Now you will find that you are in a better tax position, right? So therefore, for an income emergency provision, when you're buying a liquid fund, that is typically why you would be buying it, but otherwise you should be going for something else, as we have repeatedly said. So if that is happening, then what you need to do is keep in mind that it's a 3-year plus period that you should be looking at when you're actually investing in a liquid fund, right? So for periods below that, you should be looking, that's basically you need the money right away or in a short period. It should be something else. It could be fixed deposit, it could be something else. What could the other thing be in mutual funds? It could be, you could look at an arbitrage fund. You can also look at an arbitrage fund which is taxed as an equity investment, which means below 1 year, capital gains made in less than 1 year, taxed at 15%. For more than 1 year, it is taxed at 10%. For the gains above 1 lakh rupees, till 1 lakh rupees, if there is no tax, that is seen as long-term capital gains. The gains that you make under 1 year, short-term capital gains, and the gains that you make for above 1 lakh for when you cross 1 year of holding that investment, you pay 10% long-term capital gains tax. So that's something that you can look at as a supplement for your emergency fund. So these are some of the things that you need to keep in mind. Remember the 10-year annual average of inflation has been 7%. So that's where, because you're getting inflation indexation benefits in liquid funds, like in all debt funds, therefore it starts coming into play and gives you a certain advantage that you should be looking at to take full advantage of. So this is roughly the play that we wanted to convey to you. Do check out our previous discussions on capital gains tax, whether it's equities or others, and also in our playlist, and also our discussion on emergency funds, where we have discussed in detail about all how to build them up and how to determine the amount and the strategies. And if you've liked this discussion, hit the like button, share it with others, and subscribe to our channel. Take care of yourself. Till the next presentation, wait for us. Till the next time, take very good care of yourself, and goodbye.